Good afternoon.
Steve, I think we might have lost you. I don't, he may have fallen off. Okay, well, hey, guess what? I'll introduce Tom then, and I'm going to just say he's from MOCA. He's been doing this economic stuff in the construction industry for a long time. Actually started off more as a hobby, and but he has a great...
I'm back.
Oh, okay. Go for it. Let's try it again.
Sorry.
No, that's fine.
Pushed the wrong button. I don't know what happened.
Okay, well, don't push any more buttons.
I know. I apologize. Yeah, I'm proud to introduce a co-worker. Tom Sanders is the lead economist for MOCA Systems. MOCA is a leading owner's representative firm providing program and project management service nationally. Tom received his BS in economics from the U.S. Air Force Academy in 1980. He has a master's in cost analysis from the USAF Institute, AFIT, in 1983. He's a retired U.S. Air Force Reserve Colonel with 30 years of service, has extensive experience in cost and economics in the construction and weapon system acquisition field. Tom provides an independent market analysis for military construction projects, special cost, and economic analysis for the U.S. Army Corps of Engineers and Assistant Secretary of Defense for Acquisition and Sustainment. A recent project he managed was the Tyndall Air Force Base Reconstruction Market Assessment post-Michael. He's also authors MOCA's quarterly construction economics called Today's Construction Economy, currently in its 12th year, which he will talk about today. Welcome, Tom.
Thank you much, Steve. And Eric, Dick, thanks for giving me the opportunity here. This is me. You can go on to the next slide. Interesting how this whole thing evolved. I am the chief economist, a lead economist, and the only economist at MOCA. Because most firms don't really have room for an economist. I do special studies primarily. So our folks are cost estimators and schedulers in the group that I support directly. And about 12 years ago, prior to a couple acquisitions, we were L3. At the time, it seemed reasonable, since we were just coming out of the Great Recession, that somebody try to get their arms around what the market was doing. Because it really wasn't just about drawings, designs, quantity takeoffs, and pricing. It was much more than that, and nobody really could get their arms around it. And so I stepped up and said, well, shoot, let me do some research. And I think Eric had alluded to the fact that this really did start out as a hobby. I started poking around and looking at what passed for blogs at the time and webinars, passed for webinars at the time, and a number of magazines and documents, and just kind of pulled together a bunch of economics insight, I guess you'd call it. So today I want to explain to you and kind of describe the evolution of this newsletter. Again, 12 years ago, we made this up. Our general focus has really not changed in 12 years. I'll get into some of that. The pre and post COVID scenarios I'd like to lay out, because we've gone through a lot, as everybody knows, over the last 18 months. And all that's been captured in these newsletters. So this is a good place to kind of get a perspective of what's happened. And then I always like to take kind of a snapshot of the regional market. So we'll take a look at San Antonio here. Okay, again, our objective is to highlight market forces primarily for our owners. So although contractors find this useful, our focus is MilCon project managers and OSD project owners. Okay, so this started out, as I mentioned, several years ago, 12 years ago, I guess, at the end of the Great Recession, in fact, the last month. Well, how are we going to get our arms around this? So there was talk of shovel-ready projects and green shoots. I'm sure you remember those terms. I'm not sure any of that really meant anything. Here we are 12 years later. The third bullet there speaks to the summary. The newsletter is a 2-page compilation of a bunch of quotes and observations from industry experts. And I pull it all together at the very end. So that third bullet is what was pulled together at the end of that very first newsletter. You can see that coming out of the recession, there was large unemployment, understandably. Bid values were extremely low because contractors were hanging on for dear life if they were still around. Sounds a little bit familiar, although we've come out of this most recent recession much differently. There was, and I always try to put some forecasts in, and at the time I thought, well, although these bids are really low, they're going to catch up and indeed surpass escalation. So that was the forecast back then. The newsletter came out monthly. That became too hard, so then we pivoted to quarterly. The newsletter stopped as I left for what I thought were greener pastures, only to return a couple of years later. So I've stayed engaged with MOCA ever since August of 2015. So the newsletter, as I mentioned, comes out quarterly in the first month after the quarter. So this is October, and there's a newsletter coming out this week. So the quarter, of course, ended back in September. So let me see, and so I mentioned before, what I really do is I compile observations from experts. I'm not one. I don't have a staff. I'm fully billable on direct projects. So this indeed is an overhead effort, but it does, I think, add some value to our cost estimates and our schedule assessment. All right, next slide, please. Right, our philosophy, it hasn't changed much, but I tell you that COVID has really kind of thrown a curveball. It's kind of breaking some of the old rules. I'll get into that with the red highlighted text there. Again, the industry's done the research. They have expert observations and opinions. My focus is on selling price, and owners are concerned with selling price. So throughout the newsletter, and I don't know, no show of hands necessary here because I probably couldn't see them anyway, but if you guys have seen the newsletter, you'll note that every observation has an arrow up, sideways, or down, pointing to the fact that that quote in and of itself might increase selling price, might lead to a decrease in selling price, or is inconsequential, we can't tell. So this is helpful because you can kind of take a scan of the newsletter and see if there's a majority of red arrows going up or a majority of green arrows going down. Very simple. It's impossible to isolate cause and effect. So there's the economy is very dynamic, and trying to say that, well, gee, I know selling prices going up because steel went up 75% this year, so I guarantee selling prices going up. Too many variables in play. Construction is very elastic, although it's number 4, although we're scratching our heads on this one a little bit because higher highs but lower lows. Well, we never went that low compared to the economy because construction was determined to be an essential service. And so there are a lot of extenuating circumstances here, and they're almost impossible to forecast any considerable amount of time into the future, especially when COVID happened. So it was something like a natural disaster that like COVID is. Construction lags the general economy. Again, this didn't happen because although the economy tanked, we didn't so much. So that, don't know how to refine that model. Economists usually make up a new theory and something doesn't follow the rules. Well, here's a candidate. Okay, cost trends of inputs are masked by margin considerations. Again, just because in labor costs and material costs are high, doesn't necessarily mean that bid prices will be high, at least not right away. We are seeing bid prices go up, and indeed, selling price inflation is the highest it's been for non-residential construction in 20 years right now. You guys have probably seen that. And then finally, there are selling price leading indicators. And this is really the focus of this presentation, is that you guys can in the absence of understanding exactly what the forecast is going to be, you can get some idea of where we're headed, first of all, by reading the newsletter, but also by looking at some leading indicators and some trends. Next slide, please. There we go. So what do our clients want to know? This is, again, the primary focus of the newsletter. It's designed to inform our estimators and schedulers, but it also has come in handy for about 4,500 recipients every quarter. So our clients want to know what's going on in the market that they can isolate. I mean, the main thing about construction, as was noted, I was kind of bored in the weapons systems world. So I was estimating bombs and missiles at Eglin and satellites out in LA and airplanes out in Wright Pat in Ohio. But those all have kind of constrained markets. I mean, not many people buy F-35s. The difference between weapon systems, of course, and the market for construction is that we DoD compete with the private sector. And in fact, we are a little microcosm of the construction market. Commercial greatly is much, much broader than we are, and so is state and local in education. So we're a small piece. We are really at the mercy of what these other markets, what these other players, much bigger players in our market exhibit. So we've also got unique OSD design and construction constraints, base access, certain rules for how we build. So these are all issues that the clients want to know. Well, gee, am I hurting myself here, and do I have any way out? So those are insightful to clients. Also, they want to know what the general trends are. What's the labor shortage doing to skilled labor? What's capacity? Natural disasters, how is that going to impact construction? Supply chain challenges, of course, everybody knows about that right now. They want to know what the experts are saying, where we'll be, should I delay my project? These are all questions that our owner's rep side of MOCA asks a lot. We have construction estimators and schedulers, but we also have owner's reps. And those guys will ask me regularly what's going on in my market. All right, next slide. So lots of data sources. These are probably sources that you'll recognize. A lot of news and graphics that I get. I do like to put in a number of graphics into the newsletter, so you'll see that. EGC and ABC are very proactive in this space right now. There's a lot of webinars coming out, a lot of periodic presentations that they'll provide. ENR has monthly reports, and I read those. The Wall Street Journal is very informative. AIER is a good source as well. There's a guy named Ed Zorensky who is he used to be with Gilbane. He was a chief estimator over there, and he has the best economics blog. In case you're ever interested in checking out an economics blog, I'm not sure this group would be, but it is the best one. So getting on his site is a treat for folks like me. I also look at confidence indices. I'll comment later that they are really drivers in forecasting. There's a great correlation between the confidence that the industry has in general and what's going to happen with construction 6, 9, 12 months into the future. Another leading indicator that I look at is AIER's Architectural Billings Index, ABI. If architects are busy, then contractors going to be busy a year or so later. And then there's empirical evidence and a regional perspective from the folks that I work with at MOCA. Right, next slide, please. Okay, shout out to the guys who really do the work. You may recognize the organizations here. I don't know about the names. Anirban Basu, very animated presenter. If you ever have a chance to watch him, he's excellent. Richard Branch at Dodge, Ken Simonson, and again, Ed Zarensky. So these are the guys who put a lot of information that's out there into perspective and make my job easy. Next slide, please. Okay, so a little diversion here for a minute. Why should I care about the market? I mean, why can't I just look at the design drawings and estimate quantity takeoffs and price those out and just be done with it and throw in 10%? So what I did was I built an estimate in a project called PACES. It's a parametric estimating tool. Somebody likes the presentation. Right. So back, the estimate is for a 40,000 square foot office building at Tyndall. And I had an 18-month construction schedule. So this is just a parametric estimate, very top level, not a lot of detail here. Next slide. So I did feel like I needed to break out some detail here. So, so as you can see, I have a number of cost elements that I derived. The ones highlighted in red are the ones that I want to pay particular attention to and draw your attention to. We do a pretty good job of estimating direct costs. Some of the other cost elements that are more market related, we may not do as good a job. How much time do we really spend assessing? It turns out that's 38% of the rest of the estimates. We don't, I would submit we don't spend a lot of time doing that. Excuse me 1 second. Right back. Sorry, guys. We have some construction going on here, and I can barely hear myself. Okay, so next slide, please. All right, I further aggregated those categories. And as you can see here, it turns out that we spend an awful lot of time deriving direct costs. And we should, because they are a majority of the total project cost, 44%. Total 1391 cost. All right. The accuracy, therefore, is pretty high. And these are subjective assessments. These are my assessments. I've run them by some of the guys here, but still, you could argue them. We're not here to do that. Overhead and profit, we don't spend much time. We have a medium to low because profit is what it's all about in these dynamic markets. Escalation, well, you know, we don't spend any time with escalation. We probably just take a look at what OSD recommends, which is 2%, which is always wrong. And then we have to try to figure out how to adjust for that in the other cost elements of the estimate. So these red highlights, again, are the areas that I want to focus on. We spend 3% of our time dealing with this 38% of the estimate. So over here in the bottom section, you can see that I've made some assessments or judgments about what the repercussions of being too low on the estimate would be. So for example, direct costs. If you underestimate direct costs by 5%, the potential shortfall in the estimate on the far right is 350K, 352,212. If you, let's go down to escalation now. If you underestimate escalation by 25%, say you assume maybe a 3% inflation rate instead of a 4% inflation rate, not much difference there. And I don't think any of us would give that a second thought. You're going to underestimate by $615,000. So that's the biggest number here by far. But just a little bit of perspective as to why it maybe makes sense to spend a little bit of time paying attention to these market forces. Next slide, please. Okay, selling price indicators. Next slide. As I mentioned, I'm into trends and charts and relationships and that sort of thing. Love to have the time to build an econometric model with 35 independent variables that could forecast escalation 5 years out, but we don't have that overhead, and I'm not sure that would be worth it. Right, so you can see what's happening with materials here. Of course, nobody can argue this. We've all seen it. It's through the roof. Next slide. Another perspective, same story. Inputs to construction. This includes not just materials, but labor as well. So you can see that we are in unprecedented times right now. Next slide. Right now, this slide, I don't know if you've seen this before. This relates the inputs to construction to the bid price. I mentioned that just because materials are going up doesn't mean that bid price is going up, and that indeed didn't happen. Contractors were eating it back in, if you look toward the left there, August, September, October, November of 2020, right after, shortly after COVID emerged. Over time, though, you can see that bid price started creeping up. Bid price is the blue line at the bottom. You can see that crept up, and right now, through August of 2021, 5.2%, again, an extremely high inflation rate for selling price. Some of these materials, very dynamic as they are still up there. Well, I don't know that I do know that we're not out of the woods. Next slide. Okay, so this relates those cost indexes to price indexes. You can say, well, there's a year and a half lag, or there's a year lag. Actually, there's no correlation. If you look over on the right there, those correlation coefficients for cost versus price are meaningless. So there's something else at play out there besides input costs, clearly. And this may be intuitive, but this just proves it. All right, next slide. All right, construction confidence indices. I mentioned that I like these because there's nobody like the guys who are experts in the industry and who have real skin in the game to make the calls. They're investing for the future. And so it makes sense that they would be informed. So today's, and there's a couple of them. There's the ABC's Construction Cost Confidence Index, I should say. Down below the ENR's Construction Industry Confidence Index. And then there's something that really isn't a confidence index because it's an objective measure, but it's AIA's Architectural Billings Index. So all of these are diffusion indices, which means that if they're above 50, then things are going to be better. If they're below 50, not going to be so good. So you can see that the 63, 54, 62, those are all well above 50. These are today's, as of September's confidence indices. All right, ENR 68 is considerably above 50, and then the Architectural Billings Index is above 60 as well. This, in the face of increasing materials and worker shortages, there's still a huge amount of confidence out there. Next slide, please. Just to correlate these, they all seem to move together. These indices all pretty much say the same thing, just based on the fact that they're all above 50 by a significant amount. It took the industry a while to recover. As you can see, we were bordering on, and I think that it was more like 08, 09, and 2010 when these indices were below 50. But now, save for COVID in 2020, all these indices have been positive for some time, and they're really shooting up right now. So again, almost defies logic in some cases with all the challenges that are going on in the construction world right now. That the community is extremely confident. Next slide, please. Okay, and you can see that these do have a correlation that's strong. Over here, if there's a 1 year lag, so what we're saying is when the community is confident of the economy, a year from now, we're going to be better. We're going to be selling volume, sales are going to be up. So that is good news for for contractors, maybe not so good news for owners. So I think that we're not going to see the end to price increases. We're still going to, into 2022, we're going to see pretty significant price increases. Next slide, please. I mentioned about escalation before. The OSD is required, I know, because a lot of our guys complain about this constantly, to use a 2% annual escalation rate for MILCON projects. And that's simply not realistic, and this shows it. In fact, it's interesting, this is out of a UFC 370101. So this is a government document, and they acknowledge that the 2% is wrong. In fact, here's the actual escalation. It's averaged 2.5%, but you can see how it's really jumped around. And in some cases, under this actual price escalation column, in some cases, it's been significantly over 2%, double at least. Ever since, my goodness, ever since 2014, it's been almost at least double. In 2020, amazingly, escalation was 2%. I don't know if that means somebody forecast COVID or what happened, but it did come in right at 2. So anyway, this is a challenge that we all deal with if we're forced to use this escalation rate. Again, an argument for taking a look at what's really happening out there. Spend more than that 1% of the time doing the estimate to focus on getting the right number. Next slide, please. Okay, I mentioned before, the Wall Street Journal makes clear that this is nothing like previous recessions. This was last year. And it also notes that with the COVID recession, nothing really changed except for an artificial halt in demand and supply. All the underlying currents were still there. People still want to get things built. People still want to work. There's a lot of things that left to its own devices, the economy can just be fine about. That's not a political statement. It's simply a fact. Next slide, please. Okay, let's take a look at the pre-pandemic construction to today. Next slide. And so back in the first quarter of 2020, this newsletter came out in April of 2020. And so this is what we were seeing. We're just seeing the very beginnings of a COVID problem. At the time, trade policy and an unprecedented growth trend were in charge. Things were doing very well. Labor rates were rising. Material and equipment were stagnant or falling. That's certainly not the case anymore. Demand was driving prices higher. So there were rosy predictions back in January, February, March of 2020 for construction. It looked like it was going to be clear sailing for quite some time. Prices were increasing. This story about strain capacity and the difficulty of retaining skilled labor has been around for a long time. And I'm not sure we're going to see the end of it, but it was certainly a player back here in early 2020. Next slide, please. All right, here's a series of charts. Bear with me if you can't see them too well, but I think they're pretty descriptive. These show trends for various components of the construction economy for the last 3 years. So the upper left there is the monthly construction spending. And you can see that 2021 actually has higher spending through August than either of the prior 2 years. So spending is high. That doesn't mean volume is high necessarily. It means prices plus volume, prices times volume is higher than it has been. All right. Just to the right of that chart is the backlog. So the backlog has been a concern. A lot of projects stopped in 2020, and they're just coming back online. So contractors are concerned that they didn't have sufficient backlog, but we're getting better. We're getting better. Construction confidence. Okay, the decline continues, but it actually, as I pointed out, it's still above 50. It's still pretty significant. It's going down, but it's increasing at a decreasing rate, I guess is the way to say that. So we're still very confident, the community is very confident of a resurgence in the next 9 to 12 months. We're going to see even higher continued pricing and volume. The bottom three charts, there's a construction starts, construction jobs. We're below pre-pandemic numbers. And that chart in the middle on the bottom doesn't really tell the whole story, because this is residential and non-residential combined. And the disparity between those two is great. We've lost something like 35% of non-residential construction jobs since COVID, and we haven't gotten them back. And as you know, there's many jobs that go unfilled in construction. So this is very possibly one of the biggest hindrances to an explosive recovery in construction. Next slide. So here we were. Here we are now. There's been a remarkable recovery, and we see huge strains on the supply chain. Skilled labor shortage continues. Non-residential, as I mentioned, is well below pre-pandemic levels. Confidence is great, though. Contractors are finally increasing prices. They're not absorbing those material increases that they had seen before. And inflation is huge. And then infrastructure. What to make of infrastructure? Thank goodness the states fund most infrastructure, because if we were to wait for the federal government, I'm not sure if that ever happens. It's the next big thing and always will be. Next slide. Okay, a little look at the regional markets here. So this was an interesting chart that Anirban Basu with ABC put up. And he shows the employment, the 25 largest metros from pre-COVID to today, as of August. So look at some of those cities. This surprised me. I'm looking at the Midwest here, in the northern Midwest, Chicago, St. Louis, Detroit. Huge increases in construction employment. And then I'm over here to the far right, toward the bottom, Houston. Well, that's energy and oil, I'm sure. And some of these other states that shut down more so than others had negative construction employment growth. But I think the reason for this is that the one area in construction that's really booming, warehousing, distribution, transportation. And these cities up here, manufacturing, these cities up here, you could make an argument for are really engaged and all in warehousing and manufacturing. So I think that's the reason, manufacturing related construction. All right, next slide. All right, a little picture of the San Antonio area. You can see that San Antonio had impressive employment growth for a number of years before the COVID recession. But since then, it's been a little bit tougher for San Antonio to recover. I presume you've seen that. The nation as a whole has done better. Texas as a state has done better. So this was surprising to me when I dug up this data a couple of weeks ago. I didn't know that. It looks like those lines on the right are converging, and San Antonio is going to catch back up again. And it might just be that it's a large city, and it just takes a little while to get back on your feet. Next slide, please. Right, this is wage growth. U.S. wages in construction have greatly improved over the last several years, whereas the wages in Texas and San Antonio have not. They have fallen. So again, I did not do a deep dive into this. I don't know why, but that's also an item of interest. I don't know if that is going to change as capacity starts getting maxed out and pricing bids start coming up again. But that's what I see. Okay, next slide and final slide is don't be this guy. There's information out there that can inform you so you can go beyond the 1% of time that we spend putting these estimates together. Now, it is true that economists have forecasted 9 of the past 4 recessions, but we've learned some things, all right? We've experienced all aspects of the construction industry business cycle. We've been through a couple of them. Some of us are, I heard some reference to some old guys out there. You guys have seen these behaviors now and then. And so, you know, we've learned some stuff, and those relationships and those charts that I showed, those trends, those hold in most cases. Again, COVID has kind of thrown a wrench into a lot of it, but in general, there are reasonable relationships that you can draw and inform your project managers, your cost team about what's coming up. It's always important, and we always seek to get bid values or award values for the estimates that we prepare. And it's also a good idea to have kind of a database of those sorts of information for projects in your region, so that you can see the trends over the course of a number of months. COVID has modified the rules, as I mentioned. And there's a limit to how far contractors will put themselves out there. So they've reached that limit, and I think that they're no longer absorbing all the input costs and keeping bids low. I don't think there's any concern for that anymore. I think that the bids are coming up, and that's something that our owners and Milcon project managers should be aware of. Okay, next slide. So that is it for me. I will take questions if we've got time. It's about 12:20, so Eric or Dick, I'm glad to entertain questions.
Definitely, we've got some time for some questions, so shoot away. Does somebody have a question out there? You can either put it in chat, which I'll be monitoring here, or just unmute yourself and shoot away. Hey, Tom, while they're thinking about questions, I have a question. How do I get access to your newsletter?
So that last slide, send me an email. Okay. And I will be glad to send it to you.
Well, that'd be great. Yeah, I'd like to definitely get it, and I'm sure others would as well. Mm-hmm. If somebody could just pop that into chat real quick, that helps some people just do a cut and paste. Mm-hmm.
You know, I don't know if I mentioned this, but the very first presentation I gave on this topic was to the San Antonio chapter of CMAA 2 years ago. It really wasn't anything that I thought anyone would be interested in, but they enjoyed it, and I've come back to that same forum since then. So delighted to be speaking with you guys.
Yeah, I just put in chat Tom's email address. So just send him an email if you'd like to get a copy of his forecast. Okay, what else? Any other questions out there on this presentation?
Hey, Tom, this is Colonel John Baker with the Army's Installation Management Command, and I've got a question for you regarding what do you think are reasonable inflation rates as the government tries to determine program amounts for future military construction. And so the context of that is the Army just last year began a 10-year program, if you will, or plan for spending its very valuable infrastructure dollars. It's called the Facility Investment Plan, or FIP. And they're just kicking off now the next 10-year look ahead, which is for fiscal year 22 through fiscal year 31. And the strategic problem that we have is whenever everybody in the Army goes and looks at their restoration and modernization requirements for existing infrastructure, and then adds to that everything they want to build in order to modernize or what have you, it comes out to about a $65 billion bill with a B. And then when they look at what the appetite of the Department of Defense and the Department of the Army has to spend, it's about $16.8 billion, or roughly 1/4. And so from the get-go, you only have 25% of your requirements to spend, and you're spreading it out over 10 years. And so if everybody priced their project to start today, if when they're at the end of the line, they're not going to have as much buying power. And so I'm interested in, what do you think we should appreciate the program amounts by each year, so that we don't have this situation where somebody, says, hey, we want to build a whatever $10 million barracks, but 5 years or 10 years from now, to build that barracks, you really need $15 or $20 million. What are your thoughts on that? Over.
Oh boy, there's a lot to digest there, sir. Yes, I appreciate the challenges of programming FIDIP in advance. 10 years is crazy. So there's that 2% number out there, and that's what the programmers will allow you. Your question is, what's real? I think that for the next, 3 or 4 years, we are over 4. That's starting today. Those projects that you mentioned probably don't start for another 2 years. And then after that, I don't know. I must back away from anything that far out. I can tell you though that the nation, I don't have to tell you, you know this, the nation is desperately in need of infrastructure. And the more hotels start caving in and bridges start falling apart, I think there's going to be just no appetite for that. It's absolutely ridiculous what's going on in Washington, where they can't pass the one bill that everybody knows needs to happen, infrastructure. I know why that's happening. Everyone does. So I think that fact alone is going to continue to boost inflation, maybe 4, 4, 4, 3, 5, 3, 5. I think it's going to stay up between 3 and 4 for maybe out through the 10-year process. Now that's off the top of my head, no data to support it kind of a thing. But the observations are that it's harder to get people. You've got to do something with infrastructure. I think it's a train wreck. You guys have quite a challenge. I will not deny that. I live here in Niceville, Florida, where we have hurricanes coming in all the time. And I look at the Corps and different communities bolstering all of the levees and all the support for natural disasters. What about the man-made stuff that we've got out there, the physical infrastructure that we're going to have to improve? So the demand's there, which suggests that inflation and escalation is going to be a little bit more robust than we ever thought. Hopefully that gets you.
I'm not excited by the number, but I do appreciate your answer. Thank you.
Okay.
Yeah, I think that was going to take about maybe a couple of years of analysis, because it's a tough problem, right? And they all face it. And Colonel Baker, in that MCOM world, he is dealing with B numbers. So these things, like you were showing an example where it's a 600,000 or whatever. He's talking about millions difference.
Well, his challenge is 16 billion versus 65 billion. That's just a non-starter.
Incredible. Hey, still open up for questions, so unmute yourself.
I think there's one in the chat.
Yeah, I did see that from Terry Reed. Tom, Terry Reed asked this question about, is it harder to attract workers in construction? And she mentioned that she does have, she knows it's hard in the service industry, but what would you say? Is construction a little bit harder to attract workers, and what does that look like?
Well, construction is amongst the hardest industries to attract workers, and there's several reasons for that. It's not as tough as the service industries like restaurants, but construction is a physical. I mean, you've got to roll up your sleeves and be physical. This is also not a political comment, but it's simply a fact that fewer young folks are joining the industry. You can speculate as to why, but I won't. But that is a fact. So it's harder to attract workers in construction, I think, because it's a physically difficult thing to do. And it is, like I said, near the top of the industries that are having a challenge getting workers, skilled workers especially. I did read, and I will share with you one anecdote that I thought was interesting, is that, we 10 years ago, we started to push for emphasizing four-year college degrees. And I think that was harmful to this industry, and you could argue to most industries. And it's been proven that you don't need a four-year degree to succeed in this country. And that the push toward that and away from the trades, which I think the trades are coming back now. You see a lot of schools and two-year programs. But I think that was harmful, and I think that we're reversing that trend, but it's not happening overnight. The wages are good. I mean, construction wages are generally they're above the average national wage, so compensation is good. But I just think it was that push toward four-year degrees.
Okay, yeah, thanks, Tom. Mm-hmm. So, any other questions out there? Mr. Myers, do you have a question? Normally you have a question. You're like the the bearer of all questions for us, and you're currently muted. So if you can unmute.
I might have answered all those questions, Eric.
You answered my question before I clicked send or enter. That is,
okay. All right, Bill.
Did individuals get this newsletter? Very interesting job. Thank you, Don.
All right, thank you. My pleasure.
That sounds great. Well, hey, Tom, thank you so much. I'm going to share my screen again real quick, just to show you what you get for doing this brief. And
I kind of like that medal.
You like the medal?
Yeah, I like the medal.
You got to be a SAME member for 10 years, or I'll just give you a possible, if you attend the Centennial Holiday Gala, you might get one. I'm not going to promise it. However, you could get a medal by attending that event. It's a possibility. So,
thank you very much.
This is a very
active chapter, Eric. I was listening to everything at the beginning. You guys have a lot of attendees for a virtual conference. That's great to begin with, but all the events that you've got coming up, I think that's wonderful.
Yeah, it's an awesome post, and it's good. So anyway, Tom, thank you so much. Presentation. I personally, because I am in the construction industry, personally loved your presentation, and a lot of insight in there. And I know this is sort of like predicting the weather a month from now. We have no clue, right? The reality is it's tough. It's hard, and so it's difficult. But you're sticking with it, and at least allowing us to get an insight into some of that was great, and I appreciate it. And I'm going to certainly sign up for your newsletter. So
very good.
Okay, so hey, with that.